Welcome back to Bitcoin Insight, where we cut through the hype and get to the truth. Today we're tackling an urgent problem. In 2025, the crypto landscape is more sophisticated and more deceptive than ever. Every day you'll hear catchy slogans from influencers and platforms promising instant riches, the next Bitcoin, or tokenized real-world assets that will change your life. But beneath those glossy headlines lie myths that could drain your wallet and your confidence. In this episode, we'll expose 4 pervasive crypto myths, show you real-world examples of how they're pushed, and above all, explain exactly how to protect yourself. If you care about your capital and your peace of mind, listen closely. Let's jump in. Myth 1, there will be a new Bitcoin. You've seen the ads. Faster than BTC, tiny market cap equals exponential upside, celebrity guru backing. They all promise to dethrone Bitcoin. Real-world case study 1. In late 2018, Bitcoin SV splintered from Bitcoin Cash and claimed to be the real Bitcoin. Its proponents touted higher block sizes and faster throughput. By mid-2019, BSV's price plummeted below 1% of BTC's value, and today its network is a fraction of both hash rate and developer activity. Why this myth persists? Speed fallacy. Many equate transaction speed with value, yet Bitcoin's 10-minute block time is a design choice for security. Faster chains sacrifice decentralization. Small cap trap. New tokens with $5 million market caps can double in price on low volume, but that's pump and dump, not sustainable growth. Influencer hype. When an expert with 100,000 followers tweets about next Bitcoin, retail investors rush in, only to see the price collapse weeks later. How to protect yourself? Ask, what problem does this token solve that Bitcoin can't? Check network security, hash rate, node count, developer commits. Beware market cap less than $50 million. That's small enough to manipulate. Myth 2, real-world assets, RWA, will be all about trading cards and NFTs. You've heard that tokenizing everything from art to real estate is the next frontier, but the real action right now is in stablecoins and on-chain securities. Real-world case study 2. In 2023, VanEck launched a pilot for tokenized shares of a blue-chip art collection. Despite media buzz, trading volumes barely hit $1 million per month. Meanwhile, USD stablecoins, USDC, USDT, processed over $2 trillion in on-chain volume that same quarter. Why this myth persists? Sensational headlines. Buy a $100 house on chain. Makes for clicks. But the regulation and custody challenges are immense. Collector psychology. People love the idea of digital baseball cards, but most collectors prefer physical ownership. Infrastructure gaps. Title registries, property laws, tax rules. Real estate on chain requires rewriting decades of law. How to protect yourself? Focus on liquidity. How much volume does this RWA token see daily? Check regulatory clarity. Is it approved by financial authorities or purely experimental? Prioritize tokens backed by fiat or regulated securities, not speculative collectibles. Myth 3, new payment networks will replace Visa and SWIFT. Every month you read about a blockchain that will revolutionize payments. But in reality, stablecoins already power most crypto-to-fiat flows, and traditional networks are integrating them. Example, in early 2024, a startup launched a novel payments chain promising nano fees. 6 months later, Visa quietly rolled out USD stablecoin rails on Ethereum L2, processing billions daily. Why this myth persists? Tech fascination. A new consensus algorithm sounds more exciting than Visa upgrading rails. Niche marketing. Ripple fans hype XRP for cross-border, but volume on SWIFT remains orders of magnitude higher. Lack of adoption metrics. Few report on real-world volume. The narrative of this will dethrone banks is easier to sell. How to protect yourself? Compare real transaction volume. stable coins versus new chains, token transfers. Look at enterprise partnerships. Who's really using it? Startups or major banks? Remember, a solved problem rarely gets solved again. Payments are efficient today. Focus on innovation elsewhere. Myth 4. On-chain stocks will democratize equity trading. The dream? Buy tokenized shares of Tesla or Apple on Uniswap, 24/7, no paperwork. But securities laws and exchange regulations don't disappear overnight. Why this myth persists? Anti-establishment appeal. No brokers, no borders is a powerful slogan. Early experiments. Some DeFi protocols have issued tokenized stock derivatives, but they're synthetic, not actual equity. Regulatory lag. Blockchain promoters assume law will catch up, but regulators enforce existing rules, fines and all. How to protect yourself. Verify if the token has regulatory approval, SEC, FCA, etc. Understand the legal framework. Is it a derivative or a real share? Be wary of peer-to-peer equity trades that could trigger compliance issues, or worse, be outright.